Welcome to Wealth 101. I'm Norman Howe, Managing Director of Azure Group Wealth. And it's good to have your company. Sydney property, what's going on there? Is it boom, bubble, or is it beware? There's been much in the media of recent times talking about the Australian property boom, and in particular Sydney. So today, what I want to do is to go back to basics and just have a look at some of the reasons why that might be going on. So Sydney property prices have outperformed the other states during this year, says RP Data, posting a 7.5% gain for the year. Pretty impressive, particularly when you consider it's about nearly 30% more than its nearest rival, which happens to be Perth. So what's driving Sydney's property prices growth? Well, here's a few things to think about. Sydney probably is playing catch up from pent-up demand, going back to 2008. I'll come back to that in a minute. Increased building activity from new dwelling starts, but they're mostly home units. Investors driving out first home buyers. SMSF investors, a new stream of people coming in to buy properties that weren't there before. Lowest interest rates on record, and we've got renters becoming first-time owners or becoming owner-occupiers. So demand continues to be high, with supplies coming on a bit slowly, and that's keeping the prices, quite up there. That said, building activity is starting to gather some strength now in Sydney and New South Wales, with new dwellings starting to kick up quite dramatically. In fact, about 40% this year for New South Wales, but once again, from quite a low growth. Housing supplies are pushing up prices as well. Here's a little bit of a fact from the New South Wales government. In fact, it's from the Fair Trading Minister, Anthony Roberts, who said recently Sydney is going to be undersupplied by about 140,000 additional homes, and they're going to be required by 2016. That in itself, supply and demand, is starting to push prices up even more. So, but what else is there? Well, we've got the lowest interest rates on record. So affordability is now a key issue, and why more people are buying property than ever before. Interest rates are low, but there's a bit of a trap there, and I'll come back to that a little bit later on. We've also got renters, where the cost to buy a property is almost the same as renting. So what would you do? So these people are looking at this seriously. What it's done though, it has forced out the lower end of the market. That means there's been a gap and others have come in, and self-managed super funds have been one of those. So pent-up demand in Sydney, yeah, that's been there. Anecdotally, many potential property sellers and buyers have been waiting. They've been just waiting for consumer sentiment and the general economy to become more positive. And this has been going on since 2008. And with the change of government, that seems to have done something. I'm not quite sure. But we have record Sydney property sales, indicating pent-up demand from both buyers and sellers is being satisfied. Off-the-plan unit sales are hot property right now, and often clear only after they've been online for a few days, and there's been reports of being clearances just in one day. That's not usual. So, is Sydney in a bubble? Well, in short, Sydney is playing catch-up to many of its rivals in the other capital cities. And positive sentiment in New South Wales right now, particularly Sydney, is very, very high. And people are much more positive about the future than they have been for quite some time. And as I said earlier on, have a look at Sydney's record auction clearance rates over the last few months, where many of them have been 80% or in fact more. So time will tell whether Sydney is in a bubble or not, but here's a timely warning. Go back to basics and don't be caught up in the rush to buy. There's plenty of time. Have a very defined checklist that the property must meet, particularly for investment properties. Location, past growth compared to the future, depreciation allowance for new property, it's a big deal. Rental growth, what's that going to look like? And demographics and infrastructure, they're things that you really need to take into account, and maybe in the rush you're going to miss them. Things too like being close to transport such as trains and buses. Very, very big important thing. Don't overcommit. Be sensible in the loan to value ratios. You'll see a lot of ads encouraging you to put down virtually nothing. Bit of a trap there, just be careful. Aim for at least about 20% if you're going to be buying a home, so you can not be caught up when interest rates do rise, and they will. And for investment properties, keep overall gearing to a manageable level, and assume a 50% increase in the interest rates over time. That changes the numbers. Another big one is take emotion out, particularly at auctions. Set a budget limit and don't exceed it for nothing. Don't do that. Take an experienced person with you if you're not experienced at auctions, and you must bet only with what you go into the auction with. Don't pay more than you need to. Assume interest rates will rise. Sub 5% interest rates will not last. The usual long-term interest rates are somewhere between 6 and 8%. Redo your numbers and see how you see on that. If you're borrowing at 5%, just remember, long run is 7%, so you're going to have to pay 40% more. Factor that in. And lastly, do your homework. Don't rely only on local knowledge. Get some reliable research and don't become opinionated. RP Data and many other firms have research. Go and check that out. An investment property may not be the one you would like to live in, but others will. Just remember that. Buy for price and return or buy a home, but still justify you're not paying too much. Thanks for joining us for this edition of Wealth 101. I'm Norman Howe. See you next time.